Hey everyone, and welcome in. I appreciate you joining us here on YouTube. We are going live. This is a bit of an experiment, but we're going to try it out. I am Dion Rabouin. I am a markets reporter here at the Wall Street Journal. This is Market Takes, and thank you for joining us. We're going to be talking about all things markets, the economy, really talking about the big drivers, what's moving the markets, what's going on in the real economy as well. And right now, as I look out at things, I'm seeing three very big themes for the week ahead. We're going to be talking about what we expect to see from the jobs numbers that we get. Obviously, this is Jobs Week. Happy Jobs Week to everyone out there. Also, the big theme in markets right now, as it has been really all year, that's that inflation data. We're also going to be talking about housing, which I think is a big piece that's feeding into really this whole inflation, cost, prices, all of that. So welcome into Market Takes here on YouTube, and we are live streaming. Again, I'm Dion Rabouin from the Wall Street Journal. You guys are on my page, so I appreciate that. If you haven't subscribed, please subscribe. And yeah, we're gonna jump right into everything going on, like I said, with markets, with the economy, with all that. So want to get started first things first and just check in on the markets on this Monday morning. As we're looking out, the Dow and the S&P both in the red slightly. The Dow down about 35 or 0.35%. The S&P down about 0.1%. The NASDAQ right now is positive, holding on to those gains from overnight session. Also, of course, if you know me, you know I love bonds. We are looking at the yield curve right now. We saw overnight an inversion of that 5-year and 30-year Treasury. That just, it's one of the big signals that investors watch for. It's not the big inversion that everyone really worries about. That's the 2-year and the 10-year. But the 5-year and the 30-year really does signal that we are starting to see a changing of inflation expectations and of expectations for the real economy. So we saw that 5-year, 30-year inversion. That's definitely something to keep your eye on. And the difference between the 2-year and the 10-year yield, the 10-year is still higher, but barely. I think right now we are holding on by about 18 basis points, the 10-year being higher than the 2-year. So really watch for that. I just did a video about the yield curve inversion, what it means, why it's such an accurate predictor of recession. So if you haven't, check that out. It's on the page. You can watch that. We also, of course, our team, our WSJ video team did a great video about, doing a real deep dive on the yield curve inversion. So watch that video after Market Takes, of course, after the live stream, and check that out as well. Again, the S&P right now, we are negative, but if the S&P can close higher, I think that level is about 45.87, we will move out of correction territory. The S&P has been in correction territory for 23 days. If we get out today, it would be 24 days in that correction territory, moving back into potentially a bull market scenario. So keep an eye on that. We are, for those of you who love the technical analysis, we are hitting that 61.8 level on the Fibonacci retracement scale. So if you like technical analysis, you know what that means. If you don't worry about it. It's not important. We're going to get into the fundamentals and what's really moving the markets this week and looking back at last week. So as we talk about last week, I want to point to the big event last week, and that started on Monday. It was Federal Reserve Chair Jerome Powell talking to the National Association for Business Economics, gave a speech there where he said, you know what, we could really start to think about it, and 50 basis points at a meeting, raising rates is in play. For those of you who don't follow the Fed every single day of your life, usually the Fed raises rates by 25 basis points at each meeting, or when they're raising rates, they raise by 25 basis points, 1/4%. What Powell is saying is they could double that. They could raise by 50 basis points, meaning raising interest rates more quickly, higher, and at a faster pace. Now, when he said that, he had never really said specifically, we are open to raising by 50 basis points. He said, we're going to be nimble, we're going to do what's needed. This was kind of his first public acknowledgement that, yes, that's on the table. After that, we saw a couple other Fed governors and Federal Reserve regional presidents say the same thing. Some of them who were voters on this year's committee. So we're going to talk about that, why that matters, why that was important. And we don't have any Fed speakers with big speeches right now on the calendar, but we are going to get the Fed's favored measure for inflation. We're going to get a reading on that later this week. So stay tuned. I'm going to tell you what those are, why all that's important. Like I said, I think the big themes this week, jobs and inflation. And this week is going to tell us a lot about where both of those are headed and what we can expect to see going forward, because we know what's happened and where we've been. So thanks again for tuning in to the live stream. Like I said, we're going to get into all those things and more right here on Market Takes. Appreciate all of you all who have tuned in. We're going to be, like I said, diving into real data, real economy, looking at the markets and talking about why all those things are going to move the market. So here's what we've got coming up this week. We got a big slate of data. Today is a light day. Tomorrow we get the JOLTS report, which has long been a favorite of mine. I love checking the JOLTS report. It is a comprehensive report that tells you all about what's happening in the labor market. That is the Job Openings and Labor Turnover Survey. For those of you all who are interested in some useless trivia, the JOLTS report, investors had largely ignored that, I think, coming into this year. But as we've seen this really unprecedented environment in the jobs market, I think that has really gotten a lot more attention from investors and from folks on Wall Street who are seeing, hey, this is really telling us about what's going on with the Great Resignation, what's going on with hiring, why we're seeing so many job openings, even though there are still all these folks on the sidelines who lost their jobs in, March, April, May of 2020. And I think we're still not seeing those folks get back in the job market, even though we've got over 11 million job openings. So we'll get the JOLTS report on Tuesday. We've also got the ADP payrolls report. Not a huge market mover, but I like it because it's a report directly from the payrolls processor. It's not an estimate. It's not a survey. ADP actually gives you their data. They tell you who's getting paychecks and who's not. So that's big on Wednesday. And of course, we get the big kahuna, the non-farm payrolls report from the Labor Department on Friday. That's always a market mover, but I think this time, not for the reason that it usually is. So we'll talk all about that. Remember, we got that 678,000 number back in January, or for January in February, or in March, excuse me. And we'll see if we get another big blowout number like that. There are expectations for a high number. We also get PCE, personal consumption expenditures. That is the Fed's favored measure for inflation. We're going to get that data on Wednesday, so stay tuned and buckle up for that. People, you and I, folks out there, we usually watch the CPI, the Consumer Price Index, but the PCE is what the Fed watches. That number's been lower, but historically it's still been at 40-year highs. And even the core index, which takes out food and energy, which are two things that have really been just skyrocketing off the charts, even that has been at the highest in nearly 40 years. So we're going to want to watch for that. Also, on the housing front, again, watching housing, the Federal Housing Finance Authority, or Federal Housing Finance Agency, is going to be releasing its index for the national housing. And we're also going to get the Case-Shiller home price index, both for January. A little bit delayed, but those reports are very comprehensive, and it's what people are talking about. So you'll want to watch those. Looking back at last week, I told you the big event was Jerome Powell's speech at NABE, the National Association for Business Economics, where he talked about, potentially doing 50 basis points. To me, this was Powell's whatever it takes moment for inflation. After the COVID pandemic hit in 2020, Powell came out, whatever it takes. We saw that the Fed was really willing to do whatever it took to support the market, really unprecedented measures. They've now pumped about $4 trillion out into the economy. So when Jerome Powell says whatever it takes, the market knows that he means whatever it takes. And this looked like his moment on inflation, saying we're going to do what it takes. Potentially 50 basis point increases at meetings, double the normal pace, and the market reacted. We saw bond yields across the yield curve, the 2-year, the 3-year, In the belly, the 5, the 7-year, the 10-year, all rising pretty significantly. And again, we saw the inversion today, the 5-year over the 30-year, which means we're seeing short-dated treasuries rise faster than long-dated. And now you're getting paid higher yield for a 5-year treasury note, that's a bond from the US government, than you are for a 30-year treasury bond from the government, which, if you just think about it, you should be getting paid more when you let the government borrow money for 30 years than if they borrow for 5 years. That's switching. We also heard from Cleveland Fed President Loretta Mester, and we also heard from St. Louis Fed President James Bullard, both saying, yep, we're looking at 50 basis points. When you look at the market has raised expectations for the Federal Reserve to hike rates by at least 50 basis points at its next 2 meetings. So this is being priced in, and that's moving yields way up. And it's going to be more expensive to borrow. That affects you and I. Whether we're trying to get a mortgage, the mortgage rate is significantly higher than it has been. In just the past month, we've seen a significant increase in mortgage rates. It's probably going to hit credit cards, student loans. All those things get moved based on where these treasury yields are. So that's definitely moving the market. Goldman Sachs, Citi, Bank of America, all significantly raising their expectations for rate hikes from the Federal Reserve this year. And that moves the needle. That's big. Bond yields up by about 35 basis points last week from the 2-year and to the 10-year. The 3-year actually gaining by almost 40 basis points. I think that's particularly interesting. The stock market really seemed to shake that off, though. You saw the S&P 500 gaining 1.8% last week. The largest 2-week returns. We're really seeing this consistent rise right now in stocks, even though we're seeing those bond yields really tick up. The market kind of shaking that off, which is unusual for the behavior that we've seen probably over the past years. We've seen rates rise. Like I said, the S&P rising 1.8% last week. That finished a 2-week period, which was its best 2 weeks since November of 2020. That tells you, right? We saw big moves in 2020. The NASDAQ, which has all those tech stocks, high flyers, we also saw that rise by 2% last week, outgaining the S&P 500, even in this rising yield environment. This week, I think, is going to be key to seeing, does the market continue to just shake off those yields, or does this environment really start to shake investor confidence? That's going to be big to watch, and I think really going to be telling about the shape of the market. As I talked about earlier, S&P 500 on the verge of getting out of correction territory. We are looking to need about 50 points gained on the S&P to move out of correction territory. If we do that, that's going to be, I think, telling of where the market is, where sentiment is, all those things. So looking at this week now, that was last week, we're in this week. We've got no big speech from Powell, no big Fed speeches planned, but like I said, we get that PCE data, personal consumption expenditures. That is the Fed's favored measure for inflation. Whenever you hear Jerome Powell or anyone else from the Federal Reserve talking about inflation, they're talking about PCE. And PCE last reading, was at 6.1%, highest since 1982. Even the core index, taking out volatile food and energy prices, right, to get a more stable reading of what the economy is really doing, because we know food and energy move pretty significantly. You get a lot of volatility. That measure was the highest since 1983, 5.2%. Analysts, economists are expecting to see a 6.4% increase in PCE when we get the reading on Wednesday. Again, that means inflation is rising, not peaked, not coming down. If we do get that, that could be worrisome for the markets. So definitely something to keep in mind and to be sure that you're looking out for. That PCE number this week is going to be, I think, the big kahuna of data, if you will. Also, we're going to get some housing data. I know that folks haven't been watching that quite as closely, but the housing data I think is going to be big. The Federal Housing Finance Agency's National Price Index is going to be coming out along with the Case-Shiller National Price Index. Housing, a big part of the inflation story. And housing really has been just taking off. And it's one of the things that gets slowly factored into these inflation reports. So you're going to want to look at housing because a lot of folks, whether you're a renter or a buyer, these housing prices influence what you pay. So definitely something to keep an eye on and to watch out for. Economists, we got the new home sales report last week. New home sales account for about 11.4% of all home sales. We saw that rise by about 10.7% last month, excuse me. So again, that's something to watch out for. The other piece of that is actual home sales declining as prices are rising. So in this rising rate environment where mortgage rates now are at 4.5%, we're approaching that 4.5% number, housing prices continue to rise, and we're seeing folks mortgage payments as a share of family income hitting about 20%. We're also seeing rents rise by about 17%, and that's pretty significant. We're already at a record high, rent prices at a record high, feeding all that into inflation. That's something that gets factored in slowly, and as these prices continue to rise, we could see inflation continue to rise with it. So again, that's going to be, I think, the big report, PC, but also watch out for those housing reports. Watch out for the JOLTS number on Tuesday. That's going to be the big one. And watch out for that jobs number, NFPs, the Labor Department's non-farm payrolls report coming out on Friday. That's everything that we've got coming up this week. I think all of those reports could be market movers. As you look out at the markets right now, we're going to check back in. We are seeing the Dow still negative, but the S&P has actually gotten to about even. It's up about 0.2% right now. So just in the green. The NASDAQ still in the green, up by about 0.5%. So, the market right now seems to be holding steady. We don't have a lot of data coming out today, but it does seem like the market is, hanging in there. After last week's big rise, like I said, we've had the best 2-week performance since November 2020 on the S&P 500 and since April actually on the NASDAQ. We're also, of course, watching oil right now sinking a bit like a stone. Oil down about 7.5% right now. So keep an eye on crude. Hopefully that feeds into those gas prices, brings those down a little bit, because we have seen significant price appreciation in the price of oil, which is increasing that price that you all pay at the pump. Listen, make sure you're watching the markets. Make sure you are watching the data. I hope that you'll keep watching Market Takes. We will be back with you next Monday. I'm Dion Rabouin for the Wall Street Journal. And I appreciate you guys tuning in, everyone that tuned in on the live stream. We hope you'll be back with us next week when we do this again here on Market Takes on YouTube on the Wall Street Journal.